Good evening, Mattia Lahana. Good evening. It's morning here in Toronto, and good afternoon to everyone as well. Okay, we can start. Thanks everyone for joining in. I have here on the list Mark, Mattia Lahana, Hod, Osmin, Pantelix, Alexander, Depti, and Otmar. Thanks a lot for joining in. I'm Giuseppe Basile. Today I'm going to be your host, and I want to thank Adinda and Vicky for setting up this presentation and webinar. Today I'm going to talk about the journey to profitability and then trading consistency. And there is then here, which means that there is a consequential set of action here. So without further ado, a little bit of an agenda here. I'll make a slight introduction. In this presentation, I'm going to give also an update on the market turmoil in August 2015 and the activity of the plunge protection team. This is an update because I had another presentation the month of August, in which I gave I provided an analysis of what's going on and why tracing the plunge protection team is very, very important, and also a key to understand what's going to happen in the market going forward. So then I'll get into the content, the process of becoming a successful trader, and you'll see that you have to follow certain steps. Nothing is random in this business. And how you can reach profitability, and after that, how you can work to reach consistency as well. Some of the tasks of this mental model to reach profitability and consistency, I'll talk about that. There are a number of tasks. I'll talk only about a couple of them if you have time. Take an inventory of yourself and substitute useful beliefs with non-useful beliefs. Of course, it's the opposite, right? You want to substitute non-usable belief with usable belief. And I'll give you some examples as well. I teach the FIP Stalker Memory Coaching Program. So if you are interested, follow the link below the webinar here. Now, trading is risky, and most of you know that. Maybe you experienced that on your skin as well. Past performance is not indicative of future results. And as I like to say, risk management is trader job number one. So if you are watching this webinar, the recording of it, please stop it here and read this disclaimer here. I won't spend a lot of time about myself. If you watch my previous video webinars I have on FX Street, and you read my bio, you'll discover I have over 15 years of experience with over 18,000 of total market exposure, and I founded fipstalkertrading.com, and I have some original ideas in relation to the way I identify area of potential participation of algorithms, as well as how to time these areas in a procedural way. So that's my edge. Now, why FIP Stalker? Very quickly, FIP, of course, is Fibonacci, but I use it in a non-conventional way, and you'll see here that I only use 50, 61.8%, 123.6% and 161.8%. All the others can be better explained, and we don't need them. The second part, stalker, it's to pursue or track a prey stealthily. And of course, I do not follow or observe a person persistently, okay? So to me, FIP stalking means to stalk price using some of the Fibonacci levels in order to identify area of participation. And I look at trends. I only trade retraces where the risk is low and the reward to risk is high. And once a level is identified, it's important that participation at that level brings price, in this case, in a long high enough to actually break a confirmation level. Okay, so I'm going to show some example of this also on charts today. And once participation in this area is strong enough to break a confirmation level which is well defined before the fact, then it means that this participation is strong enough to give us a free risk trade. And it's all about managing risk. It's all about getting involved when we can manage risk. Okay, so that's clear. That's key. Now, as the plunge protection team done it again. Now, before I get there, I just want to remind you that I had on July the 21st the plunge protection team and the coming U.S. stock market crash, and we had a market crash in a way, and again, I say that before the fact, and we had participation of the plunge protection team into the market to save the market. So if we look at the recent chart of the S&P 500, that's what we see, right? So we see this continuous move higher here, and then occasionally the market has plummeted into levels. Now, the level in October 2014, it was known in advance. At the time, it was 1832, and the reason why this level is different now is because this market, the S&P 500, actually has 4 contracts, yearly contracts, and this price is actually the combination of all the prices. So sometimes that changes the levels, the number in the level, but the level was actually identified before the fact. And you will see if you watch the presentation on July the 21st that I mentioned that the next retrace would come from this level here. So we traced again from this level to the highs after the market hit the first target of this setup here, and then the market came again into this area of potential support, and the 61.8% level was never pierced. So that's in a nutshell what happened here. So the way I model this behavior is using one of the 6 ways I used to model price. And as the market was extended, what happened is that when the market is extended, I don't trace from the low to high and try to capture this with a shallow 23.6. It does not exist for me. The way we model this is to tracing from highs to highs. That's only one of the model I use, and the market is actually the combination of applying these models to all time frames, and that works well only on high volume market. Okay, because these methods attempt to model what the algorithms are doing, and algorithms have only the volume to actually work on large high volume markets. So when we this is an example in which the market moved in traditional measure move here, tracing from lows to highs, capture this area. And as you can see, the market went into the first and second target here, and then we could trace from highs to highs, and we were able to capture again this area of participation. So this is not a hand-picked example, and there are students and people who work with me who know that this behavior are very regular, and there are ways to time the entry in a procedural way. So. So this was the Canadian versus Japanese yen daily. Now, in October 2014, I made a call. I was at the Toronto Money Show, and this is to make a long story short. I was invited for a talk, and then after that, I set to listen to another colleague, and you can see the full story if you watch the webinar here, as well as the webinar in July, in which I explained the full story. But to make a long story short, I had a level which was, of course, traced well before the fact, and was this level here. And in that occasion, I mentioned that this level was there, and we could actually time if there was participation at this level. Okay, and I'm going to show you the timing later on. If you want to watch the weekly review I made, you can see in minute 9, I traced this level here, potential level of support and participation long, and you can watch it here if you want to look at this was published on October 13, 2014. Okay, so what happened in the July the 21st webinar, I talked about the plunge protection team, which is the president's team for financial market, and what they do, they actually come into the market to save the market. Now, there is a relation also between algorithms and plunge protection team activity. And I showed also that modeling algorithms, the way you saw before and the way I'm going to show you in a minute, when we use the same models and we apply data to the past price data, we can see that those rules work and capture market behavior. This might be unbelievable to you, but please watch July the 21st webinar if you have not done so, and you will. I will give you the proof, and you'll convince yourself that that's the way modern market, at least high volume modern market works. So before I get into the content, let me give an update here of where the US market is headed. In the July the 21st presentation, I showed this level, and the reason why this level is very important. When we traced from this level to the highs, we captured this October 2014 low, and this could be timed as well. So the market actually participated at this 1811. So in the July 21st presentation also showed that the market has the potential to go all the way into two levels. One is the second target. Now, that never happened because the market retraced, but we were capable of capturing that retrace. And on a larger time frame, this market has still the potential to get into 2600, believe it or not. That's what large algorithms are looking at. Now, the current situation was that, as I mentioned before, this 1630 level here is very, very important. And I mentioned in July the 21st that on July 21st that you could actually use this level and trace to new highs. So if you trace from this level to new highs after the first target of the previous move that started here was hit, you could actually capture the next level. So the July 2015 call, and I'm not saying these things to boast or, but just to show that if I was able to identify these levels, you can do that as well. So it's not rocket science. Everything is transparent. If the area works, there'll be participation. You'll be able to spot participation and actually have a way to time the entry as well. So and I'm going to show you in a minute how you would have timed those levels. So the key that I given in July has uncovered the area of participation here in August. So almost 10 months later, and this is a weekly time frame, of course. So that's the reason you see such a few number of bars. So this area here, how we identified it. Again, we traced from the high to the new high after the first target was hit. And the concept to time is the one that I showed you before. Now, the level below here is the level we have here. The blue level we are here is the start of the level of the area of participation, and the red line is the line where participation ends. If the price pierces that line, I'm not interested in looking at longs anymore, because it means that shorts are stronger than longs. Okay, so that's the way you can procedurally, by identifying the sequence of measure move on the counter trend move here, you can actually identify whether there is or not participation in it. Now, if you know my work, you also know that I introduced the 7 pillars of trading in modern markets, and these are the ones: psychology of the market, method, timing. Now, here I'm talking about this piece here, and as you can see, there is a lot of focus in this area of the method and timing, but in reality, as you probably know, or if you don't know it, you will discover today, the psychology of the trader is the most important thing. That's the reason why I like to spend time talking about the trader and the psychology and how you improve the psychology, because 70% of trading success is that, and psychology can make or kill you as a trader. So we're talking about this part here now, which is timing, before I show you the timing that I have later on, let me introduce the content of today, which is the process of reaching success in trading. In a nutshell, we have 5-6 points here. In a nutshell, the trading process for success is to condition your natural psychology in order to apply the trading, risk, and money management methods. And that's the reason why I showed you this model here. This model actually kind of breaks down the trading process in pieces, and we have the method here, which gets the bigger focus. We have the timing. Then we have the money management as well, that is not always understood. It's simple, but it's not always totally understood. And of course, risk management, which is overlooked very, very often, because our natural psychology pushes us to look at the gains, at the upside, before we look at the risk. And then, of course, there is the all-important psychology of the trader. But as you can see here, and this is maybe a novel element to some of you, or most of you, there is also the psychology of the market. So what is this psychology of the market? It's actually, the way I define it, it's the aggregate behavior of traders, of the average trader, taken as a group. So it is very, very important that your method kind of captures the psychology of the market, or has elements that capture the psychology of the market. Otherwise, you're just trading a statistical table, which is what indicators are. And you will see that I don't choose any indicator. So let's go back to the process for success in trading. We said conditioning our natural psychology to apply the trading, risk, and money management methods that you have learned or you are learning in order to do what? To execute a trading system with few or no errors, to test and paper trade to build confidence first, and that helps reaching profitability, and that's the first step. And then this is followed by trading consistency. And I used a number of terms here. If you learn by heart this process here, the sequence and the steps of this process, you'll be ahead of 90% of the traders who only look at what? They only look at the mechanics of trading, which is actually summarized by the method and timing. So I used some keywords here: natural psychology, and to apply the trading, risk, and money management methods. So these are methods. Being methods, these are things you can learn. See, trading is not about learning the method. That's 10% to 15% of the story. It's not about learning how to manage risk. I have in my method 3 risk parachutes, and I look at the risk seriously. and the money manager. These are all methods. You might be surprised. The method is not the problem to become successful in trading. Of course, if you have a method with high expectancy, a method that captures something that is grounded in the way the market works, you can be more successful. It's easier to be more successful, okay? Then next, I mentioned the trading system. A lot of people want to learn a few rules or ways of looking at the market, but they never take the time to systematize that in a trading system. And a trading system, especially if you're a beginner or you are not experienced, it's a great way to model your rules, and it's a great way that helps you to actually follow your rules and understand what you're doing. And this is very important. A lot of people, they just want to look at price, want to time, but they have no idea what they're doing, their statistics. And that's why I mentioned also test and paper trade to build confidence, because there's no better way to build confidence by testing on a previous price honestly and following the rules in the trading system, as well as paper trading. And this builds confidence in a method or a new method that you're learning or you are designing as well. Some people like to design the systems as well. And once you do all this, you're sure to reach profitability, because when you test and paper trade and you don't rush into trading the markets, you develop confidence, you develop the numbers you need in order to guide your trading, and you can develop profitability, and then after that you can ante up, you can bring your trading to the next level to produce trading consistency, which is a totally different thing. Okay, so can you see how articulate, I wouldn't say complex, because most of these things taken by themselves are not complex, but the process is articulated, and you have to follow a process if you want to become profitable. And business trading is not a passion, it's a business, and it's boring whenever it has to be. If you want to be successful, that's what you have to do. So one way of looking at the process for achieving success is something like this. And this might be surprising to you, or complicated or complex, but basically, I like always to remember what Van Tarp always told us. I've studied with Van Tarp for a number of years, and he told us learning trading is all about being capable of making differences. Making differences means that you can actually look at the same chart before and after, and you will see new things, or you will see mistakes, or you'll see price behavior that you didn't see before, or actually a trait of your process, of your character as a trader that you were not seeing before. For example, not respecting the market, not respecting the risks. So we start from our level of development, and as we encounter problems and solve them, we go to the next problem, and then, eventually we believe we have profitability here, we reach profitability, but that's not the case. We go back, and at some point we reach profitability. Of course, there are some people who never reach profitability because they do not focus on building a method and a trading system that has high probability, high reliability, and a decent expectancy, or they are not capable of following it. So the problem here is split in two. And the line there is the level where we reach profitability. Now, to reach profitability, you have to have a trading method, and you have to know how to time the entry. You have to have, as I mentioned before, a money management and risk management methods. Again, all these are methods. It's like, learning how to drive your car. Believe it or not, all these are methods, which means that it can be learned. There's nothing magic about this, including your trading method and timing. Now, on top of this, in order to reach profitability and start getting into the real game. The 95% of retail traders always focus on this. They don't know when they start that the game starts here really at this level, the psychology of the market. So you have to have, excuse me, a method that somehow captures something fundamental about the market. And I call this the psychology of the market. And then the point is that once you have all the method in place, you want to have a method again that reflects something fundamental about the market, you can model all these things in a trading system. You have to do that. But the reality is that even this level here, it's not enough. It's not enough because this is still mechanics of trading. The psychology of the market is the way price responds to the aggregate psychology of the players. In a trading system, it's just a trading system. That's when the real game starts, the psychology of the trader. When we start looking inwards and we look at what we are doing, and one great way to do that is to apply the trading system and test and paper trade the trading system, and that helps building confidence. Now, when you have confidence, you're very close to profitability, but you're not there just yet. You might need to do some tuning, for example, your trading system tuning. There might be, and to do that, it's important that you know your numbers. There might be some trades that you take, but in reality, if you don't take them, you make more because they give you more losses than gain. So by doing, once you develop the confidence, by doing a trading system tuning, you really bring yourself to the level where you can reach profitability. Now, profitability might be temporary, might be something that alone you cannot, it's a level of development. You cannot bet on it. You cannot rely and lay back now on the fact that you reach profitability. You have to continue to develop yourself. And now, really, in order to develop yourself and bring your trading to consistency, you have to change completely your game. You have to go from the mechanics of trading, which are actually developed in order to reach profitability, to the mechanics of who you are and how you work. And believe it or not, the motivation you need and the hard work you need to become consistent in trading relies a lot on mission and values, who you are. And the reason for that is, and I'll show you later on if we have time, that it's hard work. If you don't have a strong mission and values that bring you and help you in the journey, you will never make it. I mean, I want to be blunt. I want to be honest. You'll never make it. And actually, I demonstrate that 95% of traders, unfortunately, never make it because they do the wrong things. And again, I want to go back to the list of webinars here. If you have not watched them, I have a few of them. And I definitely recommend to watch the How to Challenge Yourself for Greater Returns in Modern Markets. And there is a game there, an interactive game, in which I have you playing the role of a money manager, of a hedge fund manager, and how to get and stay in the elite. And in the first of this, February the 13th, I demonstrate why and what are the reasons that 95% of retail traders lose in this market, what you have to do differently. And all this series explains you what you have to do differently. I also have the 7 pillars of trading in modern market, which is very, very important to understand how modern markets have changed. Okay, so let's go back to reaching consistency here. Are there any questions so far? If you have any questions, please write them down. I'll be very happy to answer those questions. Now, continuing here, in order to reach consistency, you have to bring the game to a totally different level, and you have to understand what are your market beliefs. And again, I love to quote Van Tarp again here. Van Tarp used to say, still says, we don't trade price, we trade our beliefs about the market. I'm going to show you some of these beliefs. Some of them are very, very useful. Others are very, very detrimental for our trading and for ourselves because they can contribute to destroy our confidence as well. So that's very, very important. So next, expectation and objectives. Expectation play a great important role. And at the moment, I've started a new series which is called Trader Psychology Expectations, Objective and Pain Points, and review this as well in the second part, which is September the 23rd. Next, you have to apply game theory. You have to apply the concept of game theory by calculating a number of statistics. It's very simple to calculate the statistics, but you have to do it. A lot of people don't do it because they're lazy. They believe it's not important. They don't understand that trading is a business. And then you have to improve your trading system and whatever you have. You have to improve the rules, or you have to improve the signals that you get or remove them. Typically, you have to remove more than that, and you can play on with position sizing, which is, again, a method. Remember, this is mechanic of trading. A method that can be overimposed on your trading system in order to reach your objectives, and in this case, reach consistency. Now, so we have three areas. The first one is the mechanics of trading. The second one is mechanics of trading, trading system, and test and paper trade. The third level is totally different level. It actually involves yourself, involves your psychology, and there are ways. See, working on psychology has to be very, very practical. With my students, I work on actual problems. It's very difficult to address psychology in a very theoretical way. If this happens, then you do this. No, unfortunately, psychology, you have to work on it, working on the problems that you have also when you work on yourself. And again, as you can see here, the model is the same. Once profitability is reached, then you start again with a new problem, and then you go from one problem to the other and so on until eventually you reach that. And these three areas correspond more or less to the three areas that I cover in my Philip Stalker Methods coaching program. So if you are interested, and I'll give you also a great edge by teaching how to model the presence of algorithms on high volume market and how to time procedurally. So some of the tasks of the process, I've mentioned some of them before. Here are some others. There are 15 different tasks. Take an inventory of yourself, and this is very important. I'm going to show you why. Substitute non-usable beliefs with usable beliefs. Determine your mission and values. And again, a lot of people tend to say, "What on earth is this? I mean, why I need this, right? I mean, give me the method. Give me the way I look at the market." And my answer to you is that yes, the method is this. Is the least important thing of the least important thing of trading here is the mechanics of trading. And yes, I mean, this is very easy. This is very easy to give you. I mean, it's something that it's easy to find. Of course, there are different methods with different level of reliability and expectancy, but this is the easy part. So it's not give me if you want to reach final consistency in trading, you have to start at some point minding yourself, your mission and values, your beliefs. That's what's going to make a difference to you. And based on that, also determine your objective as a trader. Objectives are also related to expectations. Then the task, as I mentioned before, use statistics and game theory to determine probabilities and calculate statistics of your trading system. At the end, you improve and apply money management. So now you have to determine who you are with the honesty, and this might not seem relevant, and it's often overlooked. I had students reaching profitability and that they couldn't make the jump above because they were not working hard enough, and they were not knowing They were not knowing what really motivates them to bring the trading to that other level. And believe it or not, you have to understand why you are in the game for. Are you for money? Are you because you want to help others? Are you because of intellectual challenge? I started because for me it was an intellectual challenge. Actually, I wanted to solve the market myself. I was not able to solve the market myself, and I not understood at some point I needed mentors. I would still be, losing money and actually searching for ways to make all this work. Now, this is not an easy question, okay, but you have to answer it. Who you are is also connected to your mission, which is another point. And again, the purpose in life. Now you might say, Giuseppe, what on earth you are telling me? Why you're telling me that in order to be successful, I need to understand the purpose of my purpose in life? That's extremely important. Are you in the game for the money? Can you reconcile it with your mission, with your purpose in life? If your objective is only money, I can tell you your probability of success is very, very low, or it's lower. Are you for the excitement of trading? Are you for to win the game, to show your steroids? Are you in for just for intellectual interest? At the very beginning, for me, was this. Do you don't underestimate this task and take it seriously? Of course, we are in the game for the money, right? But what I mentioned here is that you need a stronger motivation in order to bring your game to a different level. Take it seriously, okay? Seriously. And ask me questions if you want to know what I mean. Cynically identify beliefs. And again, I quote Van Tarp again, we don't trade price, we trade our beliefs about price and the markets, because we filter everything throughout our beliefs. So our beliefs about the market are very important. And, deep ingrained beliefs are very, very difficult to remove. There are some people who believe that indicators is the only way to go. Have you seen any indicators in my charts? There are other ways to go. You must develop an open mind. You have to look around you and question everything and critique everything, but also keep an open mind. Be very cynical and practical about your belief. Your belief can make or break you. So it's very important that you really understand what you believe about the market. For example, I believe that in modern market, algorithms play a central role in affecting price in all time frames for high volume markets. And this is a very strong belief I have. I had not this belief in the past. I had developed it through time. So ask yourself, what are your deep ingrained beliefs? You have to notice this is a work. This is an important work, and Van Tarp also stresses the importance of this work, because see, you will only trade price based on your beliefs, and sometimes you should say, wait a moment. I'm doing things wrongly or not as I expect, but what are my beliefs about the market? Are these beliefs useful to me? Do they allow me to look at the market in the proper way or not? So write your old beliefs about the market and the trading method, and a useful way is to actually look at all the 10 parts of a trading system and say, okay, what are my beliefs on the entry? What are my beliefs on the risk management? What are my beliefs on timing? What are my beliefs about exit and profit taking and position sizing and selecting the market to trade and so on? So there are a number of them. So ask, are these beliefs useful to your trading? Yes or no? And with an open mind, creativity, discuss, let your mind wander, read, ask people who actually have more experience. And for example, do you believe in algos and their effects on the market? I do, and I see this every day as my students do. Now, not all beliefs are created equal and are useful. Here are some beliefs that are not useful. Some beliefs you have might not lead to success. Don't have any, so adopt someone else beliefs. Now, this is an activity that requires work. Okay, it requires that you stop yourself and say, "Hey, wait a moment, but what am I doing? what do I believe about this price? Some people believe, news are really what pushes price. I don't believe that. News actually move price in a very, very short term, but very often you'll see that algorithms are already placed, positioned well before the news. And the reason for that is that if you believe that this game is fair, or knowledge is totally symmetric, then I think you are living a delusion, because there is, of course, asymmetry of knowledge in the markets. And I wouldn't say that the markets are rigged, but we do not all have the same information, obviously. And make no mistake, some people will use that advantage, okay? So some beliefs might be difficult to remove. The best cure is that you require a proof. So test and paper trade the methods that are given to you. Don't rush. A lot of people lose. I showed that a good percentage, 80% of starting traders, they lose between $2,000 and $6,000 in the first 3 to 6 months. Why? Because they believe trading is easy. They believe they can trade with an expert advisor or a robot, and they lose because they never get that proof. They never test and paper trade, which is obviously important. Proof will come from experiences and experiencing and measuring. And do you risk any percentage? I know some traders who risk 5%. Now, 5% to me doesn't make sense. It's not aligned to the way the market works, the fundamental truth about the market, which is anything can happen in the market. So rather than risk a lot, I would actually rather work on the method and work on the timing in order to risk less, but try to get a higher reward to risk. So are risk-free trades really necessary? A risk-free trade is a trade whereas you enter and you have very high probability to get price to a point where your gain equals your risk. And that's where the time is to act and take 50% of the market. And people have belief saying, a belief that I usually encounter is, well, but if I take 50% out, my reward to risk is going to go low. That's true, but trading is all about risk management. It's not about making gains. If you take care of risk, gains will come. Actually, I think there is today one person, that's Pantelis, one of my students, who can testify that in the recent move higher in the euro, he did 140 times his risk. So, and he has done that by managing risk. And again, I don't say this to boast. I just say this because if Pantelis did it, you can do that as well. Or half-cooked ideas, intuition, and feelings have a reasonable justification and confirmation before you enter the market. This is where, of course, the useful beliefs, but not all of them can be useful. Let me give you a number of non-useful beliefs, at least for the way I look at the market. Okay, you might be having success without these beliefs, but I personally believe that these beliefs, sorry for the pun, are actually not very useful to trading. So partial profits only contribute to reduce gain. A lot of people will tell you, I don't take partial profits because they reduce gains. That's true, but they also manage risk. And the risk is job number one in trading. Anticipating an entry before confirmation increases the reward to risk of the trade. I had students who actually don't wait for the actual confirmation. Before I showed you that model in which we had price getting into a level of potential participation, and some people will actually see the market getting to the level, but will not wait for it to touch, or will not wait for it to actually move above the confirmation level, and they will enter before. But if you enter this area, can you see that the market needs to test that potential participation area? So risk-free trades reduce profits, of course, because you have to take partial profits. So that's what happens. But you use risk-free trades to manage risk, which is the most important thing in trading, not to maximize gains. That's something that you can do later on using position sizing. Use of multiple indicators is better than using only one. Well, this is very common, right? And I want to offend anyone, but when you use multiple indicators, you have to remember that you're using multiple statistical tables. But the most important problem is that you have to keep reconciling signals that come from these indicators. And not 100% of the time, these indicators will give the same signal at the same time. And even if they give the signal at the same time, you still have problem with timing with indicators because they give you a price level that don't give you, and a point in time that don't give you a stop loss, that don't give you a profit level. So you have to use different methods to identify other parts of your trading plan. Traditional indicators should be used for timing. Well, that's a very strong belief sometimes, but remember that the majority of traditional indicators, so MACD, RSI, and so on, were invented to capture the trend, not to be used for timing. And that's a belief, a strong belief that a lot of people have because they never took the time to research and look at and study and look at how and why these methods, these indicators were created. Indicators have predictive capabilities of price. They don't. They are statistical tables. And only when we get real participation from players, the market will actually follow the indicator. So the indicator has no predictive capability. Cluster, this is the one I love because I use Fibonacci, right? But I use it in a different way. Cluster Fibonacci levels are stronger than single levels, really? And why would that be? Because if a single Fibonacci level, it's not reliable. And you know that very well because sometimes, one level is initially tested, then it's pierced, then another level is initially tested and then pierced, and so on. So the reality is that two cluster Fibonacci levels do not have more power than one. Get on with it. I've demonstrated this as part of one of my research paper for the IFTA, the International Federation of Technical Analysts. Get on with it. There's no stronger levels by clustering Fibonacci. Okay, that's a joke. That's something that they want you to believe. So. Not so useful beliefs. We should always trade fixed lot, use soft stop loss. No, you have to use hard stop loss. Breakout entries are safer, not necessarily, absolutely not. Actually, it's better to wait for price to get to your level. And there are a number of these, but before I continue, let me show you the entry and confirmation, how it could be timed procedurally on August 27, 2015 first. And I have a question here from Pantelis. I'm close to deal with my recent problems. When I will get there, I'll try to send you a report. Okay, that's very good. Thanks, Pantelis. So thank you. And so let's look at August 27, 2015. So we had this area already in place. I remember we had this level here identified a few weeks before, because as the market goes higher, I keep tracing from this level to this level. So once the market got to this level, the market never challenged the level anymore. And this was 1, 2, 3, 4, 5 weeks before we had this level already in place. So now, again, how do we time that level? So we use the method that I told you before. So the method is we have the 50% level here, which identify our start of participation. And then we have a sequence of measure move that we have to model. We model this sequence of measure move using the same models that I showed at the beginning. At the beginning, I showed you that move, and I said which ways from highs to highs and so on. So let me show you how it worked in this case. So in this case, we had a first move which was not clean, but it was not important because when we trace from lows, highs to lows, the 50%, the 61.8% level here was pierced. That's not important because the market got participation on the downside as well. So we had our 50% level somewhere here, right? So when we trace from lows to new lows, we identify this area of potential resistance. This is an area where the market should continue lower. If the market does not continue lower and breaks this level, it means that there is participation from the larger time frame, which is this weekly that I showed you before. Okay, and what happened is that once the level was broken, the market came and traded a nice 50% level here. So the market never broke here, and you could actually time this level and get a fairish trade. The low was never challenged. Okay. So this was August 27. October 17, 2014 was even cleaner, and I'm talking about this move here. So this could be procedurally timed, and the market, when the market has this fast move, it always starts moving in extension. So in this case, it was very clean because when we traced from the low to the high to low here, the market came into this level, which was away from that 50% level that we were looking at. That is here. So this is the level we are timing. We are not entering long before. There's no business in entering long before. I had some money manager colleagues here in Toronto were entering on this kind of bars here, which really does not make sense, or in this bar here, it doesn't make sense. They're entering without understanding the structure of the market. And I don't want to boost here, but I've been looking at these things for years, and you can look at those things too. Now, when the market traded this level, and as you can see, reacted to this level twice, so there was actual participation on the short side of things from that level, okay? And where the market went, it went into the first target and second target. Once the market went below the second target, we knew that this market was extended. So when the market is extended, we need to start modeling the market in a different way, tracing from lows to lows. And this gave us another area of potential resistance. And as you can see initially, the market responded to this level here. Can you see that the market went to this level and then closed here, so below the level. So initially the market actually continued in the direction of the trend. And can you start seeing that structure that I showed you before in the schematic? The structure is this one. Can you see it? Now, when we break this level, that's the confirmation level. That's an indication that the participation that we are getting at that weekly level is strong enough to pierce this level and bring price to the free risk trade, which is 1 unit of risk in gain, which is this one, okay? So this is the way you would have timed or understood that the plunge protection team was there to actually push price higher. And you could model this using algorithms, okay? Now, Thanks for sharing that, Pantelis. So I want to go back now and continue on the belief because this is very important. So we see that there are some useful belief and non-useful beliefs. Objectives cannot be reached using money management. That's exactly the opposite. Objectives can be reached using a method, which is money management, changing your money management algorithms. And again, there are hundreds and hundreds of ways of doing this. And you have to do it in the right way. With a good trading system, psychology is not important. Well, with a good trading system, psychology is less important, or it's easier to be successful. Psychology is always very, very important, even in a good trading system, because if you don't have the confidence to follow the trading system, although good, you will not be successful. It's possible to make money without consistent result. Some people look at trading like, I want to make the big win. I want to risk it all in and make the big win. Now, very few people did that. And also the famous Williams, at some point, Larry Williams was actually risking 60% of his money. And he made over 1 million, right? But this was a gamble, okay? So it is possible. It is not possible to make money without consistent results. The probability that you will be the next Larry Williams are very, very low. He admitted this. So he's not really, to me, he's not really that hero. Sorry, guys. But he's not someone who is 60%. It's not a good example to follow. So, and, this is my style. I'm very direct. I'm very blunt if it's need to. I don't, I have no problems in backing my thoughts with my research. And it's important you understand that. So trading method is the most important aspect of trading. And that's not the case. It's only 50%, 10 to 50% of the trading. Believe it or not, a lot of people struggle with the system, but that's not where the complexity is. Useful beliefs for me, and if you get only one of these beliefs with you today, I know I did my job. And if you have to get one, please pick this one. Trader job. Number one, it's risk management, okay? Anything can happen in the market. If you manage risk, you're on top of your game. If you look only at potential gains, you will lose in this game, like 95% of people. And I demonstrated this number is real. Retraces and limit orders are the safest entries or opportunities. And I came from a background where I was trading so-called continuation moves. So a continuation moves is a move, probably most of you know that it's a move where price moves in a certain direction. Then if price corrects, then you can expect a continuation, which typically has the same size of the previous move. And usually, you apply patterns to price patterns to this move here in order to capture the breakout. But these are breakout moves. So, it's better to buy here or it's better to buy here. Try to buying here. And now, let me continue on this, because I showed you some values before. Now, if the market retraces to the 50% level here, and participation comes and you time the sequence on the smaller time frame here, and the market does this, okay? You remember that I have mentioned first target and second target. Okay. Now, if you trade a breakout, look at how close your entry is to the first target. And that's the reason why most of you, including myself in the past, have observed that once price gets into the first target, what happens is that it retraces. And it retraces below your entry level. And that's the reason why most people who trade breakouts, initially they are happy. They say, it's going well. Of course, this market could continue higher. But can you bet on that? The market can do anything. So you have to bet on the option that opposes your trading. And that's the reason why a lot of breakout traders initially have success, and then the price gets below their entry point for the reason that there is a structure in the market, and that structure has to be respected. And that structure is captured by modern algorithms. By the way, modern algorithms trade more than 80% of volume in several markets, including SP500 E-mini futures, for example. In Forex, it's a little bit less, but high volume Forex are very, very technical, which means that, of course, the participation of PPT and algos and the smart money is very, very high. So my trading method should capture something fundamental about market behavior, and again, this is very important. And my method tries to capture the effect of algorithms on price, and I believe that's a very, very important element in modern markets. High volume markets are driven by modern algorithms, this is my belief. I strongly believe this. I see this every day. I showed you a couple of examples before. Algos have internalized the psychology of the market, and this is something I show you again. I show you in the plunge protection team and the coming U.S. stock market crash. I showed you in that presentation there, so please take the time to review that. You'll learn a lot. And algos have internalized, again, confidence in trading can be developed by testing past price data, paper trading, and trading. And these are all tools that you have to use. I mean, to me, there is no business to start trading and start trading real money, right? There are all these other tools that require work. What's your motivation for trading? It is important to know who you really are. What's your mission? What's your motivation for trading? Because a lot of people, they jump on these parts here, and they're very, very important. And they just jump into trading with real money, pulling the trigger. And as I mentioned before, 80% of people lose between 2,000 to 6,000 per in 3 to 6 months, new trades. Entry timing can be implemented procedurally. And I showed you an example. This is my belief, but I showed you also that it's supported by the way the market work. Again, high volume markets. I'm not saying that these methods work on all markets, and these are not hand-picked examples. You can go back and review my weekly newsletter as well, all the examples there, and you'll see that these levels are very, very, very well respected. So I presented already this, and again, the entry can be timed procedurally by studying the sequence of measured move on the opposing move and into the level of support, in this case, the level of participation. And so this is it for the presentation today. I hope this was interesting. And if you have any question, please go ahead. In the meantime, I will just trace here the conclusion. I give you an update of the activity of the plunge protection team in August 2015. Now, again, if you want to understand the background, please watch July the 21st, the plunge protection team and the coming U.S. stock market crash. The process for success in trading, I've introduced that. I talked about how reaching profitability and consistency in trading, it's a game, it's a process that requires different skills to be developed. In the lower part, when we are worried about profitability, we worry about the mechanics of trading. As we keep reaching profitability, we start working on ourselves, we work on our trading system, we keep on our trading system. To reach consistency, we need to deal with totally different problems. We need to deal with ourselves, okay? And that's the reason why people do not reach consistency easily. We bring our natural philosophy and psychology about the market, which does not work, which works in our lives, but does not work in the market. I showed you some tasks of the model for profitability and consistency, and then I went into more detail into one of the two of the tasks. Take an inventory of yourself, very, very important. Don't underestimate that, and substitute useful beliefs with non-useful beliefs. I also gave you some example of, substitute non-useful beliefs with useful beliefs, of course. And I also gave you examples of non-useful beliefs and example of useful beliefs, at least based on the way I look at the market. You might not think the same, but that's I believe it's the right way to look at the market. So thanks a lot for watching. If you have any questions, I'm happy to take questions. If you want to learn more about the approach, about the trading method, as well about the way time procedurally and all the other methods allow you to create a trading system and test it and develop confidence in it, and then bring your trading from profitability to consistency, please join the FIPS Token Methods Coaching Program, and there is an FX rate offer that you'll find below in the link. Now, if you have any questions, I'll answer your questions, and please feel free to write down. I hope I have not missed anything here, but there are no questions. So if you have any questions, I'll wait a couple of minutes here. Otherwise, I'll thank you for joining today. I hope this was interesting. Please give me a yes if you learned something today. And okay, thank you very much. It's time to wrap up. And thanks, Pantelis. Thanks a lot for your testimony. I was not expecting that. I really appreciate that, and especially to the example for others to learn. Thanks a lot. Have a good day. Have a good evening. Have a good afternoon, and I'll see you next time. Please watch the other webinar that you find on the web. Thank you very much, Adinda and Vicky, for organizing the webinar. Have a good day. Bye-bye now.